Hello, traders, friends, and especially the ninza.co community. I'm excited to be here with you today in this webinar to introduce a new trading strategy that our team has been researching recently. Advanced trading strategy based on Fibonacci golden ratio zones. Without further delay, let's dive straight into the main topic. First, let's take a closer look at the signals from the indicator we want to introduce. This tool is designed to function across multiple timeframes and trading instruments, giving you a broader perspective on the market. Its interface follows a Fibonacci-based approach, but in a way that differs from the conventional tools you may have used before. Instead of just marking levels, it highlights price areas that could attract market interest, helping you assess potential trading zones. One of its advantages is its adaptability to different assets and timeframes, allowing you to analyze signals within specific market contexts. However, like any tool, its effectiveness depends on how you integrate it into your overall trading strategy. Take a look at its signals in action and share your thoughts in the comments below. Do you find it suitable for your trading style? First, Many of you are probably familiar with Ichimoku Cloud, a well-known trading indicator that remains widely used by traders today. Ichimoku is valued for its ability to identify trends, provide support and resistance levels, and gauge price momentum. This time, we want to introduce a new indicator that combines Ichimoku Cloud and Fibonacci retracement. The key question is, how do these two indicators complement each other? And what value does this combination bring to market analysis and trade decision-making? Ichimoku Cloud consists of 5 key components: Chikou Span, Tenkan Sen, Kijun Sen, Senko Span-A, Senko Span-B. Instead of analyzing all components of Ichimoku, I will remove unnecessary elements from the chart and focus on the most important one for this indicator: Span B. Span B is calculated as the average of the highest high and lowest low over a specific price cycle. It plays a key role in identifying trends and potential support and resistance zones. As you scroll through the chart, you will notice that only one red line remains. This is Span B. Now let's take a look at what we have done with it. A cloud is formed with Span B as its core, but it has been refined and integrated with Fibonacci retracement. What makes it unique is that this approach is entirely different from the traditional Fibonacci methods you have seen before. As you move through the chart, you will notice that the center of the cloud is Span B, and there is always a cloud leading ahead of price, acting as a key trading zone. So, what does this offer to traders? The first key benefit is its ability to forecast future trends, helping traders assess whether the price is likely to rise or fall. Span B is calculated as the average of the highest high and lowest low in the most recent cycle, reflecting the market's equilibrium over a given period. When the price consistently stays above the 50% level of that range, it may indicate a potential uptrend. Conversely, when the price remains below the 50% level, it suggests that a downtrend may be forming. When Span B slopes downward and turns pink, it signals that the trend is weakening and may move lower. Conversely, when Span B slopes upward and turns blue, it can indicate that an uptrend is developing. So, the 50% line of Span B represents the 50% price level within a cycle, which corresponds to the 50% level in Fibonacci retracement. Building on this principle, we have added the 23.6, 38.2, 61.8, and 76.4 levels to form a cloud zone, which acts as dynamic support and resistance, always leading ahead of price. Focus on the period. Slow parameter. It defines the peak-trough cycle and generates a cloud that leads price action, giving traders a clearer view of the upcoming trend. We've set this parameter to 20, meaning the indicator calculates peaks and troughs based on the last 20 candles to generate a leading cloud and golden ratio zone ahead of price action. As price moves, the highest high and lowest low are constantly tracked within this 20 candle range. And whenever a new peak trough cycle forms, the forward cloud dynamically updates to align with real market movements. If you want a wider golden ratio zone and more reliable trade signals, consider increasing this period to 50 or 100. This makes Fibonacci zones more accurate since they're based on a larger cycle. But keep in mind, setting it too high will reduce the number of trade signals. It all comes down to your trading style. If you want more opportunities, lower the period. If you prefer high confidence signals at key Fibonacci levels, go higher. So, how far ahead will the trading zone be projected? That depends on the period. Medium parameter. For example, if you set period, medium Sacker 50, the golden ratio zone will be plotted 50 candles ahead of price. If this value is too high, the cloud will be farther from price, which is great for traders looking to catch larger pullbacks in a long-term trend. But if you're a trader who wants more signals and a closer look at short-term trend shifts, lower this value to keep the cloud tighter to price action. Next, after identifying the trend, we need to define where to look for trade signals. In traditional Fibonacci trading, traders usually wait for price to reach golden ratio zones to take trades. But the problem is, you might have to wait a long time for price to return to these levels. If you're not well versed in classic Fibonacci techniques, it can also be tricky to identify trends and filter for high probability signals. Worse yet, if you misplace your Fibonacci retracement levels, those golden zones can get easily broken, making your signals unreliable. You can clearly see that once a peak and trough form, the indicator automatically maps out Fibonacci levels ahead of price action. This makes it a dynamic Fibonacci zone, adapting to real market conditions and responding to live price movements. So instead of passively waiting for price to return to fixed Fibonacci levels, you get a more flexible, forward-looking approach to spotting trade opportunities. This indicator doesn't just map out Fibonacci zones, it also leverages a special algorithm to scan, filter, and analyze candles that form within the golden ratio zone, ensuring higher quality trade signals. Instead of simply reacting to price touching a Fibonacci level, the algorithm evaluates candle structure, price behavior, and momentum to determine if the zone is truly setting up for a potential reversal. The core trade setup in this approach is the pullback entry, where traders take advantage of price retracing into the golden zone to find high probability trade opportunities. When the overall trend is bullish, the indicator will suggest a buy signal as price pulls back into the Fibonacci zone and shows signs of a bounce. This approach not only helps traders identify high confidence reversal areas, but also reduces the chances of falling for false breakouts or unreliable signals due to misplaced Fibonacci levels. Similarly, when price moves into the golden ratio zone and the current trend is bearish, the indicator will actively scan the market and suggest trade signals accordingly. As long as price stays within this zone, the indicator continuously updates and provides signals, allowing traders to capture multiple trade opportunities. Here's a pro tip for you. If you notice that price is consistently moving above or below the cloud, it's a strong signal that the market is entering a high momentum trend phase. During such times, instead of just looking for small pullbacks, traders can shift their focus to breakout or continuation trades, taking advantage of the strong price movement. Recognizing these market conditions helps you avoid weak pullbacks and instead position yourself for higher probability setups in a trending market. Right now, the trade signals are being detected within the default golden ratio zone of 38.2%, 61.8%, which is where price tends to react the strongest based on Fibonacci retracement principles. This is a prime pullback zone that many professional traders use to identify high probability trade setups. However, if you prefer to catch trades earlier, say around the 23.6% level, the indicator can easily accommodate that. All you need to do is adjust the signal detection range to include earlier levels. For example, you can set it to scan from level 2, 23.6%, to level 5, 61.8%, effectively expanding your trading zone to 23.6%, 61.8%, instead of just 38.2%, 61.8%. This gives you the flexibility to tailor your trading strategy. If you prefer to enter early and take advantage of quick reactions at the 23.6% level, you can widen your signal range. On the other hand, if you'd rather focus on deeper pullbacks with higher probability, you can stick to the 38.2%, 61.8% zone or fine-tune it based on current market conditions. At this point, a lot of traders might be wondering, why in an uptrend, when looking for buy signals, are Fibonacci retracement levels also measured from 100 down to 0? And similarly, why in a downtrend, when looking for sell signals, are the Fibonacci retracement levels also measured from 100 down to 0? This might seem confusing, especially for those used to the traditional Fibonacci approach, where retracements are measured from low to high in an uptrend and from high to low in a downtrend. Fibonacci has a unique symmetrical property that allows traders to apply it flexibly in both market directions without significantly changing their approach. For example, in an uptrend, Fibonacci levels are arranged from top to bottom as follows: 23.6%, 38.2%, 50%, 61.8%, 76.4%, with 0% at the swing low and 100% at the swing high. These levels act as support zones where price tends to pull back before continuing higher. However, due to Fibonacci's symmetry, when a downtrend occurs, the Fibonacci levels remain in the same order, but their roles are reversed. They now act as resistance zones instead of support. More specifically, 23.6% in a downtrend corresponds to 76.4% in an uptrend. 38.2% in a downtrend corresponds to 61.8% in an uptrend. 50% remains the midpoint symmetry level. 61.8% in a downtrend corresponds to 38.2% in an uptrend. 76.4% in a downtrend corresponds to 23.6% in an uptrend. This natural symmetry allows traders to identify key reaction zones in both directions without needing to modify their Fibonacci-based strategy. Next, let's dive into how to make the most out of Sky Fibamoku. Sky Fibamoku stands out because it doesn't just identify the current trend, it also projects where the market might be headed next. This dual-layered approach makes it a powerful filter for pinpointing high-probability trade signals. And in trading, that's crucial because not every signal is worth taking. Having an extra layer of confirmation helps improve accuracy and reduce unnecessary risks. Take this buy signal as an example. If the system suggests a buy, the current trend is bullish. And Sky Fibamoku's projection also indicates that the bullish momentum is likely to continue. Then this isn't just a random signal, it's a well-supported trade opportunity. On the other hand, if the current trend is up but future projections show signs of weakening or potential reversal, then this buy signal might carry more risk, meaning you should evaluate it more carefully before jumping in. Similarly, if the indicator generates a sell signal, while both the current and projected trend indicate bearish momentum, then this sell setup has a high probability. This means you're not just seeing a signal, you have confirmation that the market structure aligns with the short side setup. But to truly gauge the reliability of the signal, pay close attention to one crucial element: the upper and lower bands of the indicator, marked in white. These bands don't just define the indicator's boundaries. They also serve as dynamic support and resistance levels. In a strong downtrend, if the price rarely or never reaches the upper band, it's a clear indication that sellers are firmly in control. When the price consistently hugs the lower band and keeps printing new lows, it reinforces the strength of the bearish move. Conversely, if the price starts bouncing off the lower band and moves toward the middle or upper regions, it could signal that selling pressure is weakening, and you should reconsider aggressive short positions. Right here, you can see that we initially had two false signals. However, by applying this filtering method, we eliminated one of the noisy sell signals, as the middle line had already turned green, indicating a shift toward an uptrend. This demonstrates how an effective filtering approach can help you avoid unnecessary trades, minimize risk, and optimize your entries. Next, a buy signal appears right as the trend shifts to bullish, with future projections also confirming the ongoing uptrend. This presents an opportunity to enter a trade after the recent down phase, aiming to recover from the previous losing trade. When the market transitions from a downtrend to an uptrend with clear confirmation, it's an ideal moment to capitalize on the momentum and regain lost ground. Let's take a look at the signals on the chart using the filtering method we just introduced. This will give you a clearer view of how the filter works in real market conditions, eliminating noise and retaining high-probability trade opportunities. However, every trading strategy comes with risk, which is why knowing where to set your stop and target levels is crucial. These are the two key factors that determine whether your strategy can remain profitable in the long run. Setting a stop too tight can get you stopped out before the trade has a chance to move in your favor, while setting a target too far might cause you to miss realistic profit-taking opportunities. On the other hand, if your stop is too wide, you expose yourself to unnecessary risk, and if your target is too close, it can lower your reward-to-risk ratio. That's why in the next section, we'll walk you through how to optimize your stop and target placements using the indicator, helping you enhance your trading performance in a practical and effective way. First, pay close attention to the cloud boundaries, as these areas represent previous highs and lows. As many of you already know, past highs and lows are key liquidity zones where major trades get executed, often triggering strong price reactions. Now, I'll enter a sell trade, placing my stop just above the cloud at the signal candle. The reason? This level aligns with the 76.4% Fibonacci retracement, which is a critical last resort pullback level. If price fails to hold this level and breaks higher, there's a strong chance of trend reversal, so I need to cut the trade immediately. Another approach, ideal for traders who trade with multiple contracts, is to focus on strong, flat boundary zones areas that act as key previous highs and lows. These are regions where price has reacted sharply before reversing or continuing the trend, making them excellent reference points for splitting your targets and stops across different contracts. This allows for better risk management and profit taking. For example, in a buy trade, I would set up two stop levels. First stop just below the lower boundary of the cloud, which has shown strong, flat price action. If price breaks below this, the downward pressure could increase. Second stop at the current low, aligning with a key Fibonacci level. This acts as a secondary safety net to prevent premature stop-outs. For targets, I'd place them at strong flat highs, using the upper boundary of the indicator as a reference. These areas tend to attract selling pressure, making them logical exit points. Since the target is set far, the stop should also have some breathing room to avoid getting prematurely stopped out. This method ensures partial profit taking while keeping a position open to capture further upside potential. At this point, the price has moved significantly in our favor, but hasn't yet reached the target. Now is the time to trail our stop up to the middle line to secure partial profits. This move reduces risk and ensures that even if the price reverses, we walk away with some gains rather than letting the trade turn into a break-even or worse, a loss. Why choose the 50% level? As we mentioned at the beginning of the webinar, the 50% level represents the price, equilibrium, an important zone that reflects market stability. If price stays above it, the uptrend remains intact. However, if price breaks below this level, it signals increasing instability, and the bullish momentum could fade or reverse. By trailing the stop to this level, we lock in profits while still allowing room for the trend to continue in our favor. By now, you've probably figured it out. The 50% level isn't just a price equilibrium, it also acts as a dynamic trailing stop. So when should we adjust the stop to follow the 50% level? Let's say you enter a buy trade. You shouldn't move your stop immediately. Doing so too early might get you stopped out prematurely. Instead, wait for price to break above the upper boundary. This breakout signals strong buying momentum that pushes price past a previous high, increasing the likelihood of a continued uptrend. At this point, trailing the stop to the 50% level makes sense, as long as price holds above it. By trailing your stop with a 50% level, you allow your trade to fully capitalize on the trend's strength rather than cutting profits too soon. When the 50% level gets broken, it signals that bullish momentum is weakening, making it a logical exit point. The best part? These kinds of trades can sometimes make up for multiple previous losses or early exits, ensuring you stay in strong trends. Next, while this indicator provides strong trend analysis and key trading zones, the number of trade signals might still be too limited, especially for scalpers who need more frequent opportunities. To address this, we'll introduce a 3-in-1 indicator, multi-OSC OB-OS overlap, which combines three powerful oscillators, RSI, MFI, and stochastic. This indicator enhances trade signals by accurately identifying overbought and oversold zones, giving traders more precise entries. Additionally, we'll adjust the settings and refine the visual interface to make the signals clearer and more intuitive, ensuring traders can spot setups quickly and effectively, especially for fast-paced scalping strategies. So how exactly do we trade with this setup? Let me break it down into a clear trade checklist for you. First, pay attention to the sell signal labeled as OS. This is an additional signal that gives you more trading opportunities. However, we don't take trades blindly. We combine multiple conditions to filter for high probability setups. Step 1, a trade signal from multi-OSC OB-OS overlap appears. Step 2, the signal candle must be within the golden ratio zone of Sky Fibamoku. Step 3, focus only on the projected future trend. Step 4, if a sell signal appears within the golden ratio zone and the future trend projection indicates a downtrend, then the sell signal from multi-OSC OB-OS overlap is highly reliable. By applying these additional filters, we ensure that we're not just reacting to random signals, but rather executing trades based on strong confluences, reducing noise, and increasing the likelihood of success. A high-conviction trade setup. Most importantly, when both the sell signal from multi-OSC OB-OS overlap and the sell signal from Sky Fibamoku appear on the same candle, it signals an extremely strong selling opportunity. This confluence between two indicators at the same time confirms a high probability downtrend continuation. It creates a reliable trade entry where traders can confidently execute a short position with greater conviction. With a multi-layer confirmation, this trade setup isn't based on a single factor, but rather reinforced by multiple indicators, increasing accuracy while minimizing risk. Similarly, you can see that the buy signal from multi-OSC OB-OS overlap initially didn't appear within the golden ratio zone, meaning this wasn't an ideal trade entry yet. However, as price moved into the golden ratio zone, two buy signals from multi-OSC OB-OS overlap appeared shortly after, confirming a high probability long trade. The confluence of a buy signal within a key price zone helps us avoid premature entries when market conditions aren't fully aligned. This reinforces the importance of waiting for confirmation from multiple factors before pulling the trigger on a trade, confirming another buy opportunity. And right here, we see another buy signal appearing, presenting a new opportunity to enter a long trade. More importantly, the future trend is also projected to be bullish, further strengthening the validity of this buy setup. When multiple buy signals align within the golden ratio zone, combined with an upward trend forecast, it forms a high probability trade setup. Now, let's go through trades demo using this strategy. I'm about to execute a buy trade, but I notice that one signal appears outside the golden ratio zone. Even though the trend is projected to be bullish, taking a trade here would involve higher risk. So instead of rushing in, I wait for a buy signal within the golden ratio zone. Shortly after, two buy signals appear simultaneously within the golden ratio zone, indicating a higher probability of price moving up. I place my stop loss just below the golden ratio zone, and since the buy signal is above the cloud, my stop shouldn't be too far, avoiding unnecessary risk that outweighs the potential reward. The key takeaway here is that we shouldn't blindly follow a fixed stop target level. Market conditions dictate how we should manage our trades, so adjusting the ATM strategy dynamically is essential. The goal is to reduce risk while maximizing profit potential. Shortly after, a new buy signal appears, creating another trading opportunity without the need to wait for confirmation from Sky Fibamoku. The projected future trend remains bullish, and more importantly, this buy signal appears within a valid price zone. Shortly after, a buy signal from Sky Fibamoku appears, further strengthening the bullish outlook. Right after entering the trade, another buy signal from multi-OSC OBOS overlap emerges, indicating increased buying pressure. More importantly, the projected future trend remains bullish, suggesting that the market is likely to sustain its upward momentum. When both indicators align, the probability of a successful trade increases. At this moment, a buy signal appears, and interestingly, both indicators trigger a buy signal on the same candle. However, the projected future trend is signaling a decline. This means that even though a buy signal is present, the risk of a reversal is high. In this case, we will skip this trade because trading against the forecasted trend often leads to lower probability setups. This highlights the importance of combining trade signals with trend projections to filter out high-risk trades and focus only on setups with stronger confirmation. Now, let's move on to a sell trade. At this moment, we have a sell signal. And more importantly, both indicators confirm the sell at the same price level. Additionally, the future trend projection is still signaling a downtrend, meaning that this setup aligns with the overall market direction. Since this is the first sell signal in a newly forming downtrend, we can set a larger target to take advantage of the fresh momentum. In many cases, early entries in a trend shift offer a stronger risk-reward ratio, allowing us to capture a bigger move. Risk management tip. Even though this is a high-confidence trade, a properly placed stop is essential to avoid being taken out by minor pullbacks before the trend continues. Shortly after the previous entry, another sell signal emerges, while the projected future trend continues to indicate a downtrend. Another sell signal has appeared, showing that we can take advantage of opportunities even when Sky Fibamoku does not provide a signal. As you can see, throughout the previous trades, we have executed multiple orders based on signals from multi-OSC OBOS overlap, even when Sky Fibamoku did not directly suggest a signal maximizing the potential of signals within a trend. Next, another sell signal appears, and you can see that sell signals are consistently forming within the golden ratio zone. Price continues to hug the lower band of the cloud, moving in sync with the predicted future downtrend. With all factors aligning in favor of a bearish move, you should confidently hold your position. Next, a sell signal from Sky Fibamoku is triggered, and we will open a trade. Note, if the price has already moved significantly, consider adjusting the stop and target closer to lock in profits from previous trades while minimizing risk on new entries. All right, let's take a look at the chart and see what kind of signals this combination gives us. Let's have some fun with it before we get to the special gift we have for you. A super exciting indicator that comes free when you grab this combo. Next, the special gift we have for you is the volume delta indicator. It's a simple yet highly effective tool that helps you quickly see which side is in control, the buyers or the sellers. Here's how it works. If a candle has strong buying volume, you'll see a dark green dot. If the buying volume is moderate, it'll be a light green dot. On the flip side, strong selling volume will show up as a dark pink dot, while weaker selling volume will be a light pink dot. Before I reveal the true power of volume delta, let me take 20 seconds to announce a special promotion. Normally, volume delta costs nearly $400, but today, you get it for free when you grab the Sky Fibamoku plus multi-OSC OBOS overlap combo. But that's not all. The original price of this combo is $1,192, but because today is a special day, I'm slashing it by 50%, now only $596. This deal won't last long, and there are only 50 spots available. Once they're gone, they're gone. When the first green dot from volume delta appears in a downtrend, it signals that buying pressure is starting to pick up. If at that point price has already moved in my favor and hit a partial profit zone, I'll scale out one contract to lock in some profits and reduce exposure. If another green dot appears, it means buyers are stepping in more aggressively, which could lead to a potential trend reversal or at least a pullback. Seeing this, I'll close one more contract, further securing my gains and minimizing the risk of giving profits back to the market. Finally, if the third green dot shows up, that's a strong indication that buying pressure has fully shifted and the downtrend could be coming to an end. At this stage, I'll exit my entire position to make sure I capture the bulk of the move without exposing myself to unnecessary risk. By scaling out based on volume delta signals, I can effectively manage my exits, protect profits, and stay flexible, avoiding the pitfalls of exiting too early or too late. And the best part about this indicator, it helps you stay confident in your trade without getting shaken out by small fluctuations. Why do I say that? Let's break it down. Volume delta gives us a clear picture of buying and selling pressure. After a sell signal appears, we see a strong presence of dark pink dots, confirming heavy selling pressure. More importantly, throughout this move, there are no significant buying signals, no green dots, or if there are, they're weak. This tells us that buyers have little to no influence, and sellers are fully in control of the trend. With this insight, instead of panicking over small pullbacks, we can confidently hold our sell position, knowing the market is still favoring the downside. This prevents us from exiting too early and allows us to ride the trend properly. That's the power of volume delta. It gives you real, data-driven confirmation of market strength, so you can trade with conviction, not emotions. Now, let's break down this buy trade step by step. First, we can see that both confirmation signals appeared on the same candle, and the overall market structure was already hinting at an uptrend. When everything aligns in favor of a bullish move, this buy signal becomes highly reliable. Right after entering the trade, we saw a series of candles with high buying volume, pushing the price up aggressively. This confirmed that buyers were in full control. To manage risk, we trailed our stop, as previously explained. As price broke through a key level, we moved our stop up to the middle line to lock in some profit. Then, when we spotted a candle with high selling volume, it was our cue to scale out of the position, closing 2 contracts out of 4 to secure some gains. After that, we adjusted our stop again to further protect our remaining position. As buying volume remained strong, we held on to the trade and continued trailing our stop. Finally, another high-selling volume candle appeared. By this point, our profit was already significant, so we decided to exit the trade entirely, locking in a solid gain. Now, here's something really important to notice. Before the sell signal even appeared, we already saw a series of candles with strong selling pressure. This was an early indication that sellers were in control of the market. When the sell signal finally showed up, it came alongside a strong selling pressure alert from volume delta, shown as dark pink dots. This made the sell signal much more reliable, because it wasn't just a random trigger. It was backed by actual market momentum. Even after the entry, we continued to see multiple candles with heavy selling pressure, confirming that sellers were still dominating. When you put all these factors together, consistent selling pressure, volume delta confirmation, and the absence of strong buyers, it all reinforces the idea that the market is under strong selling control. And our sell trade is well supported. And when a sell signal appears together with a candle showing strong selling pressure, confirmed by volume delta, that's a highly reliable sell setup. Now, let's take a look at the chart and review everything we've discussed so far. A sell signal appears, followed by a series of candles with heavy selling pressure, driving prices down aggressively. When a sell setup is not just based on an indicator, but also validated by real market flow, it becomes far more trustworthy. Similarly, when a buy signal appears and we immediately see a series of candles with strong buying pressure, it's a clear sign that buyers are in control. This makes the buy signal much stronger and more reliable. In this situation, you should hold the trade as the momentum is still in favor of the bulls. Instead of exiting too early, watch volume delta for signs of weakening buying pressure or emerging selling pressure. These will help you decide when to take profits. If your trade has already reached a good profit level, consider scaling out gradually or trailing your stop to lock in gains while still giving the trade room to grow. We just spent this entire webinar breaking down Sky Fibamoku, not just showing what it is, but actually walking you through how it works, how to trade it like a pro, and how to maximize your profits. No fluff, just straight up strategy. And we didn't stop there. We also covered multi-OSC OB-OS overlap, a powerful tool to help you confirm key trade setups and stack more confluence when using Sky Fibamoku. Plus, we went deep into volume delta, showing you exactly how to read market pressure in real time and see whether buyers or sellers are in control. Now, let's talk about the deal you do not want to miss. Normally, if you wanted to grab volume delta, you'd have to shell out nearly $400. But because you showed up today, you're getting it 100% free when you grab Sky Fibamoku Plus multi-OSC OB-OS overlap. That's not a gimmick. We're handing you a top-tier tool that makes trading 10x easier at zero extra cost. But here's where it gets even crazier. The original price for this full package is $1,992, but today, and only today, it's $596. That's a 50% discount exclusively for this webinar. No second chances, no extensions. We've got just 50 spots, and once they're gone, they're gone. So if you're serious about leveling up your trading, don't sit on this. Scan that QR code, lock in the deal, and get your hands on tools that actually move the needle in your trading. And if you have any questions, drop them in the comments right now. We're still here and ready to help. Or if you prefer a one-on-one chat, just leave your email and we'll contact you directly. So how do we apply this to our strategy? First, volume delta acts as a signal to help you manage your exit. Let's say I enter a trade with 4 contracts. I'll start scaling out and locking in profits whenever a reversal volume delta signal appears. This way, we gradually close our position to secure gains and control risk. When the first green dot from volume delta appears in a downtrend after price has already moved in profit, I'll scale out 1 contract. If another green dot shows up, I'll close 1 more contract. And when the third green dot appears, I'll exit the entire position, locking in profits while managing risk effectively.